Good day and welcome to the Phoenix Mills Limited Q4FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Shishir Srivastava. Thank you, and over to you.
Good morning, ladies and gentlemen. We take pleasure in welcoming you all to discuss the operating and financial performance of the fourth quarter and year ended FY23. We hope you've had a chance to look at the results presentation shared by us. The same is uploaded on the stock exchanges as well as on our website. I will now take you through the key highlights of the results and with reference to relevant slides of the results presentation from time to time. To start with the performance of our retail portfolio. Please refer page 4 onwards of the results presentation for an update on consumption at our retail malls in Q4 FY23. Consumption in Q4 FY23 stood at rupees 2,211 crore, showing a growth of 59% over Q4 FY20. If we exclude contribution from the newly launched retail malls, which are Phoenix Palassio at Lucknow, Phoenix Citadel at Indore, and Phoenix Palladium at Ahmedabad, this number was 37% over Q4 FY20. Consumption at our retail malls was robust across categories in the fourth quarter. Some of the top performing categories were jewelry, which is up 164% from Q4 FY20, food and beverage up 64% from Q4 FY20, fashion and accessories up 62% from Q4 FY20, FEC, multiplex entertainment up 61% from Q4 FY20, and electronics up 58% from Q4 FY20. Turning to page 5 of the presentation for an update on consumption at our retail malls in FY23. This year, we witnessed the highest ever annual consumption of rupees 9,248 crore, demonstrating a growth of 33% over FY20 and slightly beyond our guidance of over rupees 9,000 crore. If we exclude consumption contribution from malls launched in FY21 onwards, which are Phoenix Palassio Lucknow, Phoenix Citadel at Indore, and Palladium Ahmedabad, like-to-like growth number is at 19% over FY20. Collections from the retail mall business for FY23 stood at rupees 2,167 crore, maintaining the quarterly average run rate of over rupees 540 crore, slightly ahead of our guidance of approximately 500 crore run rate per quarter. Moving on to page 6 of the presentation for an update on consumption for the month of April 23. Consumption in the month of April 23 came in at rupees 851 crore, up 18% compared to April 22. If we exclude contribution from Phoenix Citadel, Indore, and Palladium Ahmedabad, then the like-to-like consumption growth is at 11% compared to April 22. At Phoenix Palladium, Mumbai, renovations were underway for 2 of our key stores, Zara and Reliance Digital, and this had a temporary impact on consumption growth. We are delighted to announce that Zara has now reopened at Phoenix Palladium in a bigger, better, and more tech-savvy avatar. Moving on to a brief update on our newly opened retail malls. Starting with Palladium Ahmedabad on slides 7 through 12 of the presentation. On 26th February 2023, we marked our first presence in Gujarat with the launch of Palladium Ahmedabad. We have some images of the retail mall and its beautiful interiors and art and decor uploaded on the presentation. The mall opened with a trading occupancy of 32%, and with scaling completion of fit-outs, this has ramped up to 57% as of April 23. Trading occupancy will scale up closer to the leased occupancy of 93% by Q3 FY24. We are also glad to highlight that the trading density at this mall in the month of April 23 stood strong at 1,021 rupees per square foot per month, breaking the 1,000 rupee per square foot per month threshold very early on in its life. Moving on to slides 13 through 15 for an update on Phoenix Citadel Indore. We launched Phoenix Citadel Indore on 1st December 2022. Trading occupancy has shown a steady ramp up and is now at 79% versus 42% in the first month of its operation, that is December 22. This mall represents many firsts for us. Not only is this our first mall in Madhya Pradesh, but it is also the first certified green building in our portfolio. We are pleased to announce that Phoenix Citadel Indore recently achieved 2 prestigious green building certifications, USGBC LEED Gold certification and the IFC Edge Advanced certification. Phoenix Citadel, in fact, is the first retail asset in India to have received the IFC Edge Advanced certification. These certifications reflect our commitment to a sustainable development model across our existing and new developments, and you will see more progress in this regard across other assets in the coming months as well. Please turn to slide 16 onwards for an update on our upcoming malls. We are gearing up for the launch of our second malls in the cities of Pune and Bangalore. The construction at Phoenix Mall of Asia, Hebbal, Bangalore is progressing well. As can be seen from the photos, we are completing interior works. We have received the OC for the mall and multiplex recently. Phoenix Mall of the Millennium at Wakad, Pune is also on track and expected to commence operations by Q2 FY24, with the offices forming part of the mixed-use development set for launch in FY25. At our retail project in Kolkata, we have completed the demolition work of the old on-site structure, and currently construction activities are progressing. Pre-construction work is nearing completion. We will soon commence excavation on the site. At Project Rise in Lower Parel, which also has a retail component, requisite approvals are all in place. Excavation is nearly complete, and the RCC work on the tower foundation is in progress. Now moving on to the financial performance of our retail portfolio from page 25 onwards. In line with consumption, our rental and EBITDA growth also demonstrated an upward trend. Q4 FY23 retail rental income was rupees 340 crore, up 53% compared to Q4 FY20. Retail EBITDA for this quarter was at rupees 349 crore, up 64% compared to Q4 FY20. For FY23, our retail rental income stood at 1,312 crore with a growth of 29% over FY20. And retail EBITDA came in at rupees 1,331 crore with a growth of 36%. Moving to page 33 in the presentation. In FY23, we saw significant ramp up in leased occupancy, trading occupancy and trading density over FY22 across all our major malls. You will further see trading occupancy going up across our existing malls as we have several new retailers and formats under active fit-out currently, and we expect trading occupancies to move closer to 93-95% levels before Diwali 2023. In FY23, we have seen a cumulative leasing in excess of about 3.3 million square feet, with operational assets seeing approximately 2.2 million, including renewals and some churn. And at the new malls yet to be operationalized, we've seen leasing of about 1.1 million. We are ready for FY24 with renewed optimism, with the launch of 2 new malls within the next 6 months, a sustained consumption growth in existing malls, ramp up at existing malls at Chennai, Pune and Kurla on account of new trading area becoming operational, and consumption growth in our latest malls Phoenix Citadel, Indore, and Phoenix Palladium, Ahmedabad, demonstrating a significant upward trend. Just to talk a little bit about the gross consumption. In FY23, we've seen approximately 9,300 crore of consumption. We have an outlook for FY24 to breach the 11,500 crore consumption number, of which we expect Ahmedabad and Indore to add about 1,200 crore. We have a robust event calendar for each mall in place, with major spike events scheduled for weekends and engaging mini spike events for weekdays. We continue to invest in innovative, eye-catching decor across properties and bring in the best of brands and categories and fine dining, food and beverage experiences. We gear all of these activities towards making each mall the de facto destination for consumption. I will now request Anurag to take you through the office, hotel and residential section and the overall financial results. Thank you.
Thank you, Shishir. Good morning, everyone. I would direct your attention to page 34 to 40 for an update on the commercial office portfolio. Our commercial office portfolio is seeing improving traction, with gross leasing of about 4.31 lakh square feet in FY23, of which 2.81 lakh square feet is new leasing and 1.5 lakh square feet are renewal. The total office income in Q4 of FY23 stood at 43 crores, flat percentage year on year. Total EBITDA stood at 27 crores. Collection efficiency for the quarter was close to 97%, with collection of about 47 crores. For the year FY23, office income stood at 170 crores, which was up 7% year on year, and EBITDA was flat year on year at 98 crores. We currently have active fit-outs of over 180,000 square feet under progress at Pune and Mumbai, which will add quarterly rental income of more than 5 crores. We expect contribution to fully reflect from Q3 FY24. Moving on to updates on under construction commercial office projects. These are covered from page 38 onwards. At Phoenix Asia Town, Bangalore, with a GLA of about 1.2 million square feet, roof slabs up to 9th floor have been completed. Interior work, lobby, common area finishing is currently underway. We have commenced construction for 2 out of 4 of Millennium Towers, Pune, and we expect to launch the same in FY25. We are also engaged actively across our under construction assets, chiefly in Bangalore and Pune, where leasing inquiries from marquee MNC clientele have been very strong, and we'll keep you posted on the leasing progress made in this regard. As mentioned earlier, construction has commenced at Project Rise in Lower Parel, Mumbai. At ISML offices in Whitefield, Bangalore, excavation and shoring is in progress, whereas at Palladium offices, Chennai, construction has commenced. Launch of these offices will progressively take our office GLA from 2 million square feet to 7 million square feet by FY27. Now moving on to hospitality business, please refer page 41 to 47 of our deck. Starting with St. Regis Mumbai, the St. Regis Mumbai saw the first ever annual gross revenue and EBITDA in FY23. The operating performance has surpassed most parameters in last 12 months. This is led by resumption of foreign business and leisure travel, domestic corporate travel, social events and staycation. The year has been good in terms of F&B as well, with launch of new venues including Koishi, Koi Bar and high-end event space, which is called as 38 Manhattan. Total income for FY23 stood at 404 crores, this is up 31% from FY20. Occupancy for the year stood at 84%, and ARR was at about 14,851, which is up 21% from FY20. Operating EBITDA came in at 180 crores, demonstrating a growth of 54% compared to FY20. We have used the strong cash flows during FY23 to reduce debt by 115 crores on this asset, and also invest in capex for upgrading various facilities in the hotel. Our second hotel, the Courtyard by Marriott Agra, total income in FY23 stood at 24 crores, which is up about 20% from FY20. Occupancy for FY23 was at 72% and ARR stood at 4795, showing a healthy growth of 23% over FY20. Moving on to residential business, covered on page 46. We are witnessing very good traction in terms of residential sales, mainly led by robust demand of ready-to-move in inventory and faster conversion. We achieved an overall sale of 466 crores in FY23. Collection in Q4 FY23 were at rupees 115 crores and FY23 were rupees 369 crores. Wanted to talk about our key acquisitions. These are covered on pages 50 and 51. We acquired a 7-acre land parcel in Surat at a cost of 501 crores during December 2022 to build a retail development of about 1 million square feet. We await environmental clearance to begin construction. Currently, the clearance is in final stages of approval. We also forayed into warehousing through a purchase of 33-acre land parcel in Sona, NCR at a cost of 54 crores. There currently appointment of consultants for various work streams is underway. During February 2023, we purchased a land parcel in prime locality of Alipur, Kolkata at 414 crores to build an exclusive luxury residential development with a gross sellable area of about 1 million square feet. I would draw your attention to slide 53 onwards for our financial results. Some of the key highlights of our consolidated financial performance is as follows. Income from operations for Q4 FY23 is at 729 crores, up 47% year-on-year and up 83% over Q4 FY20. Income from operations at rupees 2638 crores for FY23, up 78% year-on-year and up 36% compared to FY20. EBITDA for Q4 FY23 was at 431 crores, up 79% year-on-year and up 111% over Q4 of FY20. EBITDA at 1519 crores for FY23, up 107% year-on-year and up 57% compared to FY20. Reported PAT after minority interest and after comprehensive income for Q4 FY23 at 244 crores and at 1318 crores for FY23. Moving on to cash flows, debt and liquidity positions covered in slide 59 onwards. For FY23, we generated about 1717 crores of net cash from operating activities. Our operating free cash flow post reduction of interest stood at about 1403 crores, vis-a-vis 501 crores as of FY22. Talking about the debt, which is covered on slide 62, consolidated gross debt, which stood at 4,037 crores as on March 31st, 2023, showed a decrease of 535 crores since March 2020. As Phoenix Citadel and Phoenix Palladium Ahmedabad became operational, the debt has been moved to operational assets, as a result of which our under construction portfolio has witnessed a decrease in debt. Average cost of borrowing is up by 33 basis points to 8.74% in March 2023 from 8.41% in December 2022. Currently, our lowest cost of borrowing stands at 7.45%. Despite RBI increasing rates by 250 bps since March 22, our borrowing costs have gone up only by 144 bps so far. As the overall interest rate in the economy starts to rise, our effort will be to minimize the impact of this on our cost of borrowing by reducing the spread charged by the banks on top of the repo rate. Further, with our under construction assets becoming operational, we expect some saving in interest rates as we refinance and convert the construction finance to a ready bank. Covering liquidity on page 64, our liquidity position as on 31st March 2023 was 1755 crores. This excludes the amount remaining in unutilized OD accounts. At group level, our net debt is 2282 crores and PML share of net debt is 1780 crores. We saw credit rating upgrades, revision and outlooks across many of our assets in last 12 months. We continue to make good progress on all our under construction assets. During FY23, we spent close to 1,400 crores in capital expenditure. We are bullish on our business prospects, and with a strong balance sheet position, our focus is now to deliver on our under construction portfolio in time and judiciously deploying our capital to expand our portfolio. With this, we would like to close our opening remarks and will open the call for an interactive question and answer session. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Vivek Ramakrishnan from DSP Mutual Funds. Please go ahead. I think we have lost the line. Next in line is Mr. Prakshit Khandpa. Please go ahead.
Hi, Shishir. Can you hear me? Hello?
Hi, your voice is coming a little muffled.
Yeah, hello. Hi, Shishir. Hi. Is it better now?
Yes, please.
Yeah. Congratulations on a great quarter and the whole financial year. Shishir, so now retail is on autopilot. I think most of the malls they've already delivered besides the rest of the two which is there and the under construction portfolio. So my question is more on the office side. Now the densification of malls. So how do we see the journey of office over the next 2-3 years? If you can just explain what areas will get delivered over the next 2 years and how is the rental ramp up going to happen in that portfolio?
So presently we have about 2 million square feet of office space which is operational, and this number is going to move up to about 7.2 million or thereabouts by end of FY26, early FY27. Out of this, the million square feet at Project Rise, Bombay, will be the one which will be the last to commence operations in the year. This year, we are expecting about 880,000 square feet of Asia Towers at Hebbal, Bangalore, becoming operational. This will soon be followed by the office building of 500,000 square feet at Chennai. And then thereafter, we will see the 1.2 million square feet in Wakad, Pune, becoming operational from in FY25. And rent generating, let's say, from the last quarter of FY25 or early FY26. So this is the current 2 million to about 7.2.
So what kind of rentals are we looking at in Chennai, 0.5 million, and Wakad, 1.2 and 0.88 in Hebbal?
See, Hebbal we're looking at, we have underwritten, I would say, the model at a lower number of about 65 rupees, but I think the current market trends are indicating about net rent of 80 upwards. Wakad in FY25 and FY26, we expect net rent to be in the range of about 70 rupees or slightly higher. Chennai, about 65 rupees. Rise is going to be end of FY26, early FY27. Here, the net rent estimates are underwritten at about 300 rupees or thereabouts, but we expect to do better than that because this asset is positioned very differently. So there are very few buildings of that nature in this neighborhood.
Okay.
We also have an expansion at, I missed talking about that. We have an expansion at our existing site in Bangalore, existing development at Bangalore, which is Phoenix Market City along Whitefield Road. We are expecting that to be delivered. It's a total potential of about 1.2 million square feet, of which the first phase is about 0.5 million square feet. and we expect that to be delivered towards the end of FY26. We're looking at rentals over there to be in the range of about 75-80 rupees or about that.
And all these rentals you discussed are excluding CAM, right?
Yes, these are net rentals.
Okay, I got it. And anyway, it will take almost 1 year to lease them out. When you are saying that these malls some of them will complete, so by FY25, like 1.25 million in Walker operational from FY25, so it will have a lease journey of at least 1.5 years?
Okay, so I'll just tell you from our current experience, since we are marketing Asia Towers in Bangalore, I think we are seeing a good traction. We're seeing very good, I would say, pipeline of demand in that city. We have not yet started marketing the Pune Walker asset yet because it's still about a year away. But we are seeing strong traction there. I think the team believes that we should at least have signed out about 70% of the leasing in about 7-8 months from getting the OC in Asia Towers, Hebbal, Bangalore. And it's typically a 2.5-3 month fit out period that one would assume before the rentals start accruing.
Okay. So, yeah. And so got it.
Complete that statement. That
yeah, sure.
I would say that the revenue is going to scale up from the first month that you start leasing out spaces, because it will take 2 months or 3 months depending on the size of the office for them to finish their fit out period. So it will scale up. Let's say from within 3 months of getting the OC and signing the first leads, you'll start seeing the first rental to start trickling. And then over the next 6 to 8 months period, as we lease 70%, you will see revenue scale up.
Okay. And just one last question on the residential piece now. So we have almost 1.3 million square feet yet to be, including unlaunched area in 1BW and then 1 million in Kolkata. So in the thing in FY24, we'll open up new towers in 1BW and also exhaust existing inventory in Bangalore portfolio. And what are the timelines for the Kolkata?
So, one Bangalore West towers 8 and 9, we have not yet launched. We are also waiting for some clarity on the TDR policy there before we proceed on that. Calcutta, we are actively working on the design development at this stage. So I think we should assume about 8-9 months for approvals and launch thereafter.
Any other land parcels besides Kolkata, like in the business development pipeline, so both for malls and residential portfolio, if you can help us with the business development being currently undertaken?
Yeah, but it's malls, unlike what you stated that it's on autopilot, it's not, because the operations are set, but growth is our focus on growth remains very strong. We continue to look at opportunities in the MMR region, Jaipur, Chandigarh, Hyderabad, NCR, Goa, Nagpur, Vizag, amongst some of the markets. I think that we do have a decent pipeline for the mall development. Residential, we are continuing to be extremely selective. It's only in mature markets where we can create a marquee product that we are looking at opportunities.
Okay. Thank you, Shishir, and wish you all the best.
Thank you.
Thank you. Before we take the next question, a reminder to all the participants, please restrict yourself to 2 questions. Next question comes from the line of Mohit Agarwal from IIFL. Please go ahead.
Yeah, thanks, and congratulations on great set of numbers. My first question, my questions are on the retail business. Now, if I look at full year FY23 numbers versus FY20, on a like-to-like basis, your retail EBITDA has grown 22%, the rental growth has been 15% and the consumption growth is about 19%. I'm just trying to understand how do we understand these numbers. If you could give some color on that, especially in the context that you've given a guidance right now in the comments that you're guiding for a 12.5% consumption growth in FY24. So could you give some indication on what could be the rental growth in FY24 based on what you've achieved in FY23?
Hi, Mohit. Varun this side. Let me take the first part of the question, which is on how the margins have changed and what has changed in the business in FY23 versus FY20. I think first up, while we have spoken about footfalls being at about 80% of back to pre-COVID levels, one thing that we have seen is the number of four-wheelers that are coming to the mall has increased, and that has led to an increase in our parking income as well. That, coupled with improvement in income from marketing, events, signages, etc., has contributed to an improvement in the EBITDA margins compared to the overall rental income growth. Secondly, while consumption has grown leaps and bounds during FY23, we have also undertaken significant churns during the year. If I draw your reference back to Shishir's opening comment, in our operational mall portfolio, which was about 7 million square feet before Indore and Ahmedabad became operational, we have undertaken renewals for 1.2 million square feet, and we have done new deals for 1 million square feet. So that's an aggregate of 2.2 million square feet. So that is roughly 30% of our operational mall portfolio that has been renewed with existing and new brands during FY23. The impact of this has been seen on the trading occupancy. If you see quarter one, we had started off with trading occupancies which were at about 85% across most malls, with the exception of Bangalore, which was at about 90. And through the quarters of FY23, we have seen a 3 to 5% increase in trading occupancy. However, as Shishir also guided in his opening remarks, we still have significant amount of areas that are under active fit-outs across malls in Mumbai, Pune, Bangalore and Chennai, and we expect our trading occupancies to ramp up to about 93 to 95% level by before Diwali 2023. So this change in trading occupancy should also lead to an improvement in our rental income, and it should support growth provided that all the brands come on stream as we have currently envisaged. Does that answer your question, Mohit?
Yeah, no, my second question was that you are guiding for a consumption growth on a like-to-like basis around 12.5% for 24. I'm referring to the 11,500 crore number that you mentioned. What could be a rental growth? Could rental growth exceed the consumption growth in FY24?
So I think consumption growth, of course, is very strong. Rental growth, it would depend a bit on the areas that come on stream. You will see the benefit in rental growth in the first 2 quarters of FY24, because about 3% of our mall area became operational in quarter 4 FY23. So you will have a spillover impact happening in FY24. At the same time, about 3 to 5% of the existing operational retail mall area is projected to become operational, before that Diwali 2023 period. So we will not be able to capture the full year impact of that. So I would say that rental growth would be in line or near about the consumption growth. But like we typically would suggest that, look at rental and consumption growth over a 3-year CAGR or a 5-year CAGR, they tend to converge at that point in time.
Yeah,
okay.
Anurag this side. I think we give a long-term view of our rental growth, while consumption keeps on increasing year on year. I think as the historical trend suggests, both of these converge over a longer period of time. And our usual guidance which we give is that rental growth and consumption growth over a longer period of time would be in mid-teens. So we're giving a 12.5% guidance on consumption for next year. But given the new assets are coming in and the ramp up and the renewal of leases, etc., I think a longer term trend will be around mid-teens.
Perfect. My second question is on the new malls, which includes the 2 malls that have started recently and Bangalore, Pune. How should we look at the trading density, let's say over a 12-month period? So what I'm trying to understand is Palacio, which is today at 95% trading occupancy and 1,300 kind of a trading density, a good proxy, or will every mall have a different journey in terms of trading occupancy and trading density?
Yeah. So I think what our expectation on trading densities is that we should very soon see Indore ramping up to about 1,000 rupees per square feet on trading density. Palladium, because it's slightly premium and the area is smaller as well, with lesser F&B, etc. I think there we're expecting a trading density to be in 1,200 to 1,300 range. The 2 new malls, I think we would wait to see open up the mall and see the initial experience or initial retailer performance and then comment on that. But I think it should be in line with our existing malls in Pune and Bangalore.
Okay. Thanks a lot. That's all from my side.
Thank you. Next question comes from the line of Pritesh Sheth from Motilal Oswal Financial Services Limited. Please go ahead.
Yeah, thanks for the opportunity and congrats on good numbers. Just continuing on, the new mall trading occupancy. I think, what is the current leasing status right now, and how much time we should take to ramp up to 85-90% kind of trading occupancy for the 2 new malls. And if you can just refresh the timeline for us. So Bangalore should be this quarter and Pune should be next quarter. Is it right to assume?
So first of all, on the operational dates of these malls, so Bangalore mall has received the OC very recently. I think in the last couple of days we received the OC for Bangalore mall. Now it's just a question of timing the launch and opening the doors to public, depending on the fit outs, the availability of people, etc., and the shopping season. We expect this to be opening either at the end of this quarter or early next quarter is where we are expecting the Bangalore mall to go up. So in roughly around July is what we are targeting. For Wakad, I think the OC is yet to be received. We are looking at August as the opening of the mall. And this will take into account some fury of monsoons is over and so your timing August. In terms of the ramp up of trading occupancies, your question around that, I think as we have seen in Indore and in Ahmedabad as well, the trading occupancy to reach about, let's say, in higher 80s or early 90s, it takes about usually, I think, 8 to 9 months to get over there from the launch. We usually open somewhere between 50 and 60% of trading occupancy and then ramping up the mall occupancy. And I think by 7 to 9 months or 8 to 9 months, the mall should be hitting late 80s or early 90s. Those were your questions, or did I miss anything?
No, that was my first question. And second, on very healthy margin performance this quarter on our portfolio, and that you have been highlighting since last couple of quarters as well, that as and when trading occupancy increases, we see an uptick in margin. Still, we are like 3 to 5% probably away from fully ramping up. What should we assume as or look at the stabilized EBITDA margin for the portfolio? Right now, probably on an average, every asset is at 100% of rental income. but how should we see it going forward once trading occupancy ramps up?
So I think trading occupancy ramp up is just one of the factors of margin improvement as you're seeing in the financials. I think a couple of other factors which contribute to margin improvement. I think one is that resi sales that they're picking up, and our premium offering in Kessaku is doing very well now in terms of sales. As compared to earlier quarters, there's more number of units of Kessaku. Also, we have taken a price increase. So that is contributing to some extent in terms of the margin update. Strategy which is pertaining to the hospitality business, I think we are maintaining a very good room rate in St. Regis, and that is what has caused the margin uptick in the hotels business, especially St. Regis. I think, and we are seeing a margin of 50%, operating margin of 50% for this year, and we expect to continue with that. Then, of course, you mentioned about the trading occupancy sort of going up and taking to the retail margins. So yeah, these are the trends, and I think we hope to continue on these trends.
Sure. That's helpful. Thank you. I'll come back on the queue for a few more questions. Thank you.
Thank you. Next question comes from the line of Kunal Lakhan from CLSA. Please go ahead.
Yeah, hi. Thanks for taking the question. My first question was on your slide 32, where you've given trading density for FY23 and FY22. If I look at the growth in the trading density across assets, it's been in the range of about 30 to 40%. In some assets like Pune and Kurla, it's been a lot more. But when I look at the average rentals per square feet per month growth, it's obviously much lower than that. So how should we look at this number going ahead in terms of will the average rentals catch up with the trading density performance that we are seeing?
I think, Kunal, directionally, we would say yes. What has happened in FY23 has also been that the recovery has been much faster than what anyone was anticipating. And that has led to significant improvement in trading densities like Bangalore at a trading density of 2100 or Pune as well. They are higher than what one might have expected had you asked us this question in FY22. And partly because of this, we have also ramped up the renewals and the churns of brand mix at these centers, because to support a higher trading density, one does need a newer category mix. We have introduced more family entertainment centers and better F&B offerings, and also brought in bridge to luxury brands at some of these centers, and those changes are extensively underway. If you were to just look at Kurla, we have opened the new Daiso store, which is the first in India. We have reopened Reliance Smart Bazaar, which is spread over a massive 80,000 square feet. We have opened new FEC centers, and going forward in FY24, you will see significant offerings as far as F&B is concerned. We are further strengthening the entertainment piece, and we are also bringing in newer anchors like Uniqlo, etc., which would open up in the second half of this financial year in centers like Kurla. So there is a full change and a revamp of the brand mix which is underway, and you will see these changes happening. And like Anurag had also mentioned in response to an earlier question, rent over a period of time will catch up with the consumption growth. So take it on a longer 3-year and a 5-year horizon.
Sure. My second question is actually a little conflicting with my first one. Shishir, you gave a guidance of about 12.5% same-store consumption growth for the stabilized malls. But when I look at our trading occupancy, right, there is obviously 5 to 6% catch-up that would happen based on the leased occupancy, which will happen this year. So of this 12.5%, 5 to 6% will come because of the trading occupancy catch up, and then there is inflationary growth of like say 5-6% or 6-7%. So essentially, are we saying that the trading density growth for the stabilized assets will be inflationary in nature?
No, Kunal, this is Anurag here. Just to do the math, I think the number which you're talking about on trading occupancy, that will only be for part year. It's not that on the growth will come. I think for whole of the year. So I think it will come in stages, and we expect that. I think the annualized impact of this will be about 3 months or so. And balance is the normal growth which is there.
Okay, so basically like your trading density growth going ahead could be about 8 to 10%. Is that okay?
Yeah, definitely.
Sure. Okay. All right. Thanks.
Yeah, thanks.
Next question comes from the line of Vivek Ramakrishnan from DSP Mutual Funds. Please go ahead.
Hi, sir. This is Kunal from DSP Mutual Fund. So my question was more on the competitive landscape, and that too in the non-metro cities. So are you seeing any sort of consolidation happening in the favor of large players like yourself? Or is the market size large enough to take care of the existing as well as upcoming supply, if any? So that was my first question. And second question was in terms of, do you plan to raise any debt in the current year through capital markets? If you can just provide something on that. That's it.
Yeah, thanks for your question. I think firstly on the competitive landscape, I mean the way we look at our strategy when we enter a city or a town is that we want to be the dominant consumption center in that city. Our offering, as you would have seen in our products, in our malls, etc., is quite different in terms of what the competition offers. I think we spend a lot of time on making it a grand affair, and we try and make it as not only the shopping hub or the shopping center for the city, but also an event center and various a play center and places where families can hang around for a full day and still not be able to cover the mall or do justice to the mall as we go along. We are not seeing any consolidation or any. In fact, the competitive activity is not much in terms of especially the opening of new malls across the country. I think there are very few players, if at all, who are venturing into this, and definitely not at the size and scale and number of the malls which we are targeting. We have many new retailers, first-time brands, etc., which sort of enter into the city when we open up a mall. So, for example, our Indore mall had about 100 plus new brands which came in the city, and also 30% of the stores were local stores of the local businesses as well. So that also gives it a very unique flavor. Similarly, in Ahmedabad, we are opening with more than 35 luxury stores and over 50 new brands again entering the city of Ahmedabad. While city like Ahmedabad had a few malls spread across. So, as I said, we try and create a differentiated product. We've not seen much of the competitive activity across in terms of especially opening the new mall, while there may be mergers and acquisition activity happening or other such activity happening in the malls. On your second question of debt from capital markets, I think you're referring to bonds, etc. We have not raised money on bonds up till now, largely because we have a very efficient cost of borrowing in terms of the lease rental discounting model. We tend to fund the construction and the land acquisition, the approvals and the construction of our assets on equity. and only when we have a line of sight available for opening of the mall in, let's say, next 6 to 9 months, that's the time when we start sort of looking at the borrowing on that asset. Our philosophy is that our assets should support themselves in terms of the debt. There should not be any cross subsidization, and only operating malls, etc., should have the debt. We don't find the bond structure of the borrowings from capital markets very attractive at the moment. But yes, we keep on evaluating, and at the right time, if the right product is available, we will look to raise money on that. There are no definite plans of raising significant amount of debt at the moment.
Thanks a lot, sir, and good luck.
Next question comes from the line of Pulkit Patni from Goldman Sachs. Please go ahead.
So thank you for taking my question. Just one on multiplexes. Now, we heard recently the largest multiplex company in the country talk about closing 50 screens, and I know those could be, in locations otherwise. But my broader question is, even if you look at multiplexes globally, as a percentage of revenue, their rentals happen to be much lower than what they pay in India. So given this uncertainty around that particular business right now, growth, how should we look at multiplexes being a significant tenant for us, and in many cases an anchor tenant?
Hi, Pulkit, Varun this side. Thanks for the question. I think multiplexes are at quite an interesting juncture at this point in time. We have seen people coming back for content when provided and packaged in the right manner, whether it was the release of the movie Pathaan or some of the recent Hollywood releases, or like we have been doing screenings of IPL matches in our courtyards, or even musical events. So entertainment as a category is, certainly here to stay, and it is something that gets people out of their houses, on every week, provided the right event is there. We have seen some encouraging responses in the multiplex category as well. Content, of course, is king, but they have also worked on improving and expanding beyond movies and becoming a one-stop destination in itself by bringing in celebrity chefs to curate the F&B menu as well. And I think, they are better placed to talk about what our initiatives that they are taking, but we definitely do see that when we are opening a destination mall in any particular city, multiplexes help us get the right audience as well. And we are also not opening run-of-the-mill multiplexes. We are opening the megaplexes. We are opening the biggest screens in that particular city with the best decor and the best F&B options as well. So it is as much as an event, not just a movie, but seeing the multiplexes is as much of an event for that particular city.
Maybe if I could just follow up, Varun, on that. So for the 3 new malls, Ahmedabad, Indore, is multiplexes would be what percentage of our total tenant? Is it be 15 to 20% or lesser?
No, so I think in terms of area, it's typically 8 to 9% Pulkit. In Indore, Inox has already opened up. They've opened up with 8 screens in Indore. In Ahmedabad, PVR will open up. They are under fit-outs at this point in time, and we are looking at about 9 screens there. And Pune and Bangalore would be larger. But in terms of area, we typically benchmark to about 8 to 9% of chargeable area for the mall towards multiplexes.
Okay, that's useful, Varun. Thank you so much.
Thank you.
Thank you. Next question comes from the line of Puneet Gulati from HSBC. Please go ahead.
Thank you so much for the opportunity. Just going back on the consumption guidance that you gave, is it possible to break down what is the same store or same mall consumption growth guidance that you're looking for FY24? So same area operating into New Year, excluding Indore and Ahmedabad. What should be the consumption growth rate on those accounts?
Hi. I think, Puneet, if we were to exclude Indore and Ahmedabad from FY23, our consumption would come at, say, about 9,000 crores from the existing operational assets, and we are looking at this going to 10,500 crores for about 10,300 to 10,500 crores.
Okay, and you're not I think 1,200 was for Ahmedabad, but you're not counting in this.
No, Indore and Ahmedabad combined. Let me clarify that.
Yeah. So Indore and Ahmedabad combined 1,200, and you're not counting in your guidance anything from the new and the Pune and Bangalore mall.
No, not yet. Not yet.
Okay. Got it. That's very clear now. Thank you. Secondly, on your office occupancy, what is your strategy? You have about 1.2 million square feet both in Pune and Bangalore yet to lease. Are you looking for what kind of tenants are you looking for, and are you looking for more smaller spaces or more bigger spaces kind of tenants?
Sorry, so is this you're referring to our offices?
Office space. Yes.
Yeah. So I think in the demand in each micro market is different. In Bangalore, the demand is actually for larger office spaces. There are tenants who are looking at taking entire tower or even 2 towers, and the requirements would range from 100,000 square feet going upwards to even 2 million square feet from a single tenant. In Pune, the demands are more in the range of 100,000 to 200,000 square feet from both Indian corporates as well as multinational clients.
Okay. And is it still possible to lease out the entire tower, given that somebody who will take the entire tower would want it to be built to suit, which is not going to be possible now, right?
Not a requirement. We do have, and I think we have internally debated whether we should lease out entire towers to a single tenant. We don't have a build-to-suit requirement, but we do see that our dependence on them, that one plan for the next 8 or 9 years of the lease term, becomes very significant.
Understood. Lastly, on trading occupancy for your malls, do you think the trading occupancy has largely been in line with what you would have thought for FY23? I thought the trading occupancy growth was slightly slower than and has been much lower than the lease occupancy for the entire of fiscal 23.
I think on a lighter note, Puneet, we have had to rework on some of our targets because of the consumption growth that we have seen, and actually work on relooking at the brand mix and the category mix in some of the malls given the very strong pace of consumption and the demand from retailers that has come in.
Okay, good. So trading occupancy should reach lease occupancy by Diwali this year now?
Yeah.
Okay. That's all from my side. Thank you so much. Yeah.
Say lease, we do keep some margin for churning out retailers, right? And I think what we alluded to even earlier on the call, a 50% consumption growth has been very strong, and that creates an opportunity for us to bring in some newer brands and categories. So we will look at some churn during the year, across the malls, and that's why we are keeping the trading occupancy target to about 93 to 95%, and not taking it up to lease occupancy, because lease occupancy is actually at 98-99% across assets.
Understood. That's helpful. Thank you so much. All the best. Okay.
Thank you.
Thank you. Next question comes from the line of Pritesh Chheda from Lucky Investments. Please go ahead.
Sir, I just have one small confusion. In your opening comments, you mentioned the new mall addition at about 1.1 million square feet. And this is basically Ahmedabad and Indore. And I was looking at my past notes. Basically, Ahmedabad is about 1.1 and Indore is some 0.7. Indore is 1 and Ahmedabad is 0.7. So it should be 1.7. So is these malls coming up in phases?
So I think both the malls have come up together. There is no change in area. So Indore has opened up with 1 million square feet, and Ahmedabad has opened up with a full mall area of 750,000 square feet. We will recheck on the opening remarks and carry out any corrections.
So then it should be 2.2 million of operational asset plus 1.7 million of the new, right?
No, okay. So I think what you are referring to is the leasing target. The leasing target only refers to new area that we leased during FY23. Some of the new malls have been leased even prior to FY23. So we are talking only about incremental leasing done during FY23. So for operational malls, we renewed or we did new deals for about 2.2 million square feet. And for the upcoming assets, which includes Indore, Ahmedabad, a Mall of the Millennium in Pune, and a Mall of Asia in Hebbal, we have done about 1 million square feet of new deals during FY23.
Okay, so but what will flow down in your numbers will actually be the operational plus whatever is this Ahmedabad and Indore which is supposed to come this year, right?
Yes, so that the financials will capture only the area that is trading and rent generating. Okay. So if you see Indore at the end of March, Indore was about 60% rent generating, and Ahmedabad was about 43% rent generating.
Okay. My second question, and this is the last question. Can you give me a blended holding in your retail assets? See, I have a separate number that Low Pearl is 100, Chennai is this, and Market City malls are different number. But what will be your blended holding in your malls, and what will be your blended holding in your retail assets?
I think it will be about 74%.
In retail?
In retail, yeah.
And in office?
In offices, it would be about 60%.
60%. Okay. Thank you very much, and all the best to you, sir. Thank you.
Thank you.
Next question comes from the line of Pritesh Sheth from Motilal Oswal Financial Services Limited. Mr. Pritesh, please go ahead with your question.
Yeah, sorry, I didn't realize I was on mute. Sorry. First question is on what is the pending capex in ongoing retail assets and ongoing office assets which you are going to complete over the next couple of years? And what is our capex target for this year?
Just 1 second. So the pending capex across all our assets which are under construction is about 4,650 odd crores, which covers all the assets of retail, office, etc. Our capex spend is between 2,000 to 2,300 crores every year, and we expect to do the same for FY24 as well. That's the amount of capex we spend.
2,300 crore every year. I mean, this year it was lower. Like, you also include land investments as well in this?
No. So capex, we close to about 1,500 is on the actual capex, and balance is on the land acquisition.
Correct. Okay, got it. And second, just existing leasing status at Bangalore and Pune malls, which are coming up. How much you have leased in them?
Both the assets are in 90s as far as status is concerned.
Okay, got it. Thank you.
And this is on retail. Of course, office, as we said, Bangalore.
Yeah.
The commercial office we have started marketing because we are very close to getting the OC for the office building. and this will be launched this year. For Pune, because it's still a year away, we have made very initial pre-marketing efforts, but not pre-leasing or marketing the property.
Sure, got it. Thank you.
Thank you. On behalf of Phoenix Mall Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.